Last week, we talked direct recognition versus non-direct recognition loans in whole life. This week, we're going over how to manage your IUL for maximum growth. This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Viqueira with Net Wealth Finance.
All right, how to manage your IUL for maximum growth. I should specify maximum cash growth, but in the IUL, cash growth is directly related to the death benefit in most every case. So let's start with the very beginning of the process, purchasing an IUL, because if you don't own one, how are you going to manage the cash growth? What do we look for to maximize the growth when we're purchasing an IUL?
Well, I think it comes down to the initial design and approach to things. And we're going to have that increasing death benefit so we can get a good amount of cash in there. And we're going to also likely have a term blend so we can minimize those expenses. So those are that initial foundation for getting to how can we put maximum amount of cash in there with the minimal amount of expenses. And that's kind of that first layer. If you want growth, having that high ratio of cash and getting as close to that max funding possible when we have an optimal design, I think that's the layer one foundation.
Yeah, I couldn't agree more. The two things that I do when I'm looking to design a high cash value IUL for optimal efficiency is use an increasing death benefit, because that increases the amount of MEC space, the amount of money that the government will let us put in before we turn it into something that's called a modified endowment contract and not life insurance. And then we're also going to minimize those expenses as low as possible, which means we only need as much death benefit as the amount of money we plan on putting into it. And we want to minimize the amount of commissions that are going to be coming out of that. Or in the case of IUL, the target premium, because the insurance company uses that number to determine how much commissions are going out, but in general, how much money they need to recoup in expenses. Because target premium also refers to how much they put out in expenses to sell you the policy besides commissions, like underwriting and medical exams or ordering medical records, all of those things. So beyond those two things, obviously we want to utilize a product that lets us do those things as well. Now, all the IULs, we do have the option of an increasing or a level death benefit. And then a lot of them will add a third option, which is a return of premium death benefit. And that's generally not as efficient as using that increasing death benefit. Now, there are some circumstances where you might utilize a different MEC test. Generally, when we're talking about the MEC limit and designing it with that increasing death benefit, it's because we're utilizing the guideline premium for the MEC test. But there can be some circumstances where the cash value accumulation test might be the better choice. And I've usually encountered that when I'm working with somebody that might be older and they're putting a limited amount of money into the policy, or I should say a set amount of money. They don't necessarily plan on funding it for very long.
Yeah, and I think that those design elements can oftentimes lead to a conversation. And I think the majority of folks are going to fall into one big bucket, but there are those outliers, especially as somebody who might be a little bit older, might do that CVAT, that cash value accumulation test, and that might be more beneficial for them in their circumstances.
Since this podcast is about pulling back the curtain, I will let you know that I'm doing a super secret test with a couple of my policies that I've actually purchased a cash value accumulation test design for a very specific reason. Not very many people will end up utilizing this design if it pans out the way that I'm expecting it to pan out. But I won't even have an answer to this test for still another 6 years that I own this policy. And I'm not really going to give any more hints about it, but it does have to do with what the funding will allow me to do. And there's a unique situation with a unique carrier where I have this option to do something when I use that cash value accumulation test. So in 6 years, check back in and I will reveal the results of this. But even if this pans out the way that I expected it to, or the way that I'm hoping that it will, it's still going to be a very limited use. So don't worry too much about that when you're looking at a design. That guideline premium test is usually the best way to go. Not just because we get that high MEC limit and the ability to fund it for a very long period of time, but most carriers include the overloan protection rider or loan protection rider when you're using that guideline premium test. But some of them don't include it when you don't use that test. When you use the cash value accumulation test, you don't get that overloan protection rider. And I view that overloan protection rider as a pull the ripcord in an emergency type of rider. I don't expect we will need it, but if you accidentally borrow too much money out of the policy and you're relying on it to live, the worst thing that could happen is you're out of money in your policy and it lapses because of that. And now you also have a tax bill on the gains. You're going to be in a world of hurt. We want to avoid that. That's what that loan protection rider is designed to do.
Yeah, I think we've covered a lot of the aspects around design, and I think those are important points. I think moving into that next phase of, well, now you have the policy, or as you've landed on how you're going to fund and how you're going to design the basics. Well, one of the other choices you got to have is what indexing strategies or what allocation strategies are you going to use inside of that policy? And different carriers are going to have different options on the table. Some are going to have proprietary indexes. Some will have S&P tied ones. You'll have the fixed account. There's a lot of different options, but I would tend to say using something with some kind of bonusing strategy and being a bit more aggressive in those early years, especially if you're younger and you're stuffing a lot of cash in there, you can have a few of these different strategies and allocating to them so that you can have pretty good diversification and pretty good growth opportunity.
That's an interesting approach. I differ a bit in that approach. And there's a couple of ways that I come at this with my clients. Either they pay attention to the stock market and we're using the IUL as a specific tool that's going to give us some different type of exposure, or they don't really have exposure to the stock market and this might be their initial type of exposure and they just want something that's going to have that downside protection, and maybe they're looking for more of a set it and forget it type of approach. In the set it and forget it type of approach, we may end up with some type of a fairly aggressive strategy in the early years, or we might just take something that's diversified that's going to get us consistent growth over time. But for everybody else, or somebody that wants to just spend a little bit of time managing this policy with the index options, meet with your agent at least once a year. Talk to them about where the market is at. What is it doing? What are the different index options in here giving us exposure to? And what's likely to happen over that next year? Some policies will have 12 different annual point-to-points because they do a sweep every single month. You have 12 different opportunities to earn growth over that time period. Some policies, you might just have one annual point-to-point. So talking to your agent, you can look at, as long as they're familiar with the market and the index options that are available, they can look and see, okay, this is kind of what we're expecting to happen, or this might be a good approach. I start with one of two methods. Either we're going to start with a defense or an offense, and we're going to choose our indexes based on that. But that's usually the beginning of the conversation. Over the next year, does it look like we should be playing offense or defense? And then we'll go from there. Now, I pay attention to the stock market every single day, and I pay attention to all these different index options that are in the top products that we work with. The products we don't work with, I don't pay attention to. So there is a limited number. Obviously, none of us have an unlimited capacity to look at every single thing that's available and know everything about what's going on in the market. But you got to focus. You got to be able to specialize in the top products that you sell, know those index options and what they give you exposure to, and then have a general understanding of the market so that you can advise your clients each year. So meet with your agent every year and try to optimize for that next year what the index options are going to be doing.
Yeah, and I think there's different ways that you could kind of play the defense and offense and sort of middle of the road as well. And one of the things in my own policy that I'll do is I'll have something that has the asset charge and then I'll have something that has the 1% bonus, or the 0.9 in my case. But so that those two can sort of end up offsetting, and you can choose to allocate one more to one or to the other. If you're in it sort of, you think you're bullish on the year, allocating more to that asset charge side. But there's different strategies that you can use to implement if you are trying to be a little bit more on offense or on defense in your growth strategy.
Okay, so the purchasing phase of the IUL, it does also include that first year of choosing your index options. So I like where we started with that. The next thing after you buy your policy is you've got to fund it. I have a video out recently on my channel where I went over the importance of max funding your IUL. Remember, we're buying this and our goal is maximum growth in this particular topic that we're talking about here on this one. How to manage the IUL for maximum growth. You've got to max fund it. That gets the expense ratio, which the expenses in your policy are going to stay fairly similar year to year. They're just going to go up a little bit as you get older, and that cost of insurance goes up a little bit as you get older. So if the expenses stay almost the same and you continue to max fund it well above the expenses, the expense ratio, how much those expenses are compared to the overall balance in your account, drastically reduces year after year. So in the first year, you might see a 10% expense ratio. But by the time we get to year 7, we should be under 1% in a well-designed and well-funded policy. And 30 years down the road, we're hoping for like a 0.1, 0.2% expense ratio. It should be so low that we don't even consider it to be much of a factor if there's a down year in the market.
And that's where I think a lot of the haters kind of get this wrong in the IUL space, is that if you do this right, if you max fund your policy, and even on conservative numbers, you can have a really strong cash value position, 10, 20, 30 years down the line. And as James said, when you're talking about a fraction of 1%, that expense ratio, even in those super late years where you've dropped down, now as we get into those later years, we have another strategy that we'll implement, which we we drop down to that minimum corridor of insurance that is required. And that is where we keep that policy. And those expenses are extremely low. So when you've stopped funding this and you're just in your retirement years, you can have those expenses be so low. I mean, and it's relatively speaking, because if you have a lot of cash value, in the end, the minimum amount of life insurance in your old age, it still can be kind of expensive if you just think about it in raw numbers. But we're talking about in relative terms to your cash value and your growth potential, such that even just your guaranteed crediting strategies, they can more than enough cover those expenses in that policy.
Yeah, we have some IULs that offer a 1% guaranteed bonus each year if you're using certain index options. And the expense in those policies in those years should be 0.1%, maybe even lower. When we look at the IRR, the internal rate of return of some of these policies, you go 30 years down the road, and the average expense ratio will take the assumed growth rate and we'll look at what the IRR is. And the difference is your average expense ratio since inception. That average expense ratio is going to be something like 0.2 or 0.3%. That's probably 3 to 5 times lower than your best designed whole life policies for a long-term expense ratio. So we don't get the guarantees in whole life, but we can really drive down those expenses. And money that doesn't go to the expenses goes to the cash growth every single year. So the key to that maximum cash growth in the IUL is to drop those expenses down whenever you're done funding it. Now, you got to be careful, because if you make a material change to a policy, effectively your MEC limit, the amount of money you can put into the policy moving forward, will go to zero. So we usually don't look to make a change to switch from increasing death benefit to level death benefit and reduce to the guideline minimum until we're done funding it. That usually coincides with retirement. Well, the actual insurance inside of these policies, it doesn't even get quote unquote expensive until you're in your mid 70s or even in your 80s. So we're going to be reducing the amount of insurance before it even gets expensive. And it really just helps to juice that cash growth. Now, I got to be clear. I do have a conversation with my clients. This doesn't happen automatically. The change doesn't happen automatically, which is a good thing because you want to have a conversation with your client when they get to the point where they're going to stop funding it. And you're going to have a matter-of-fact conversation. I tell them straight up, I'm going to ask you, how long do you think you're going to live? Because if you think you're going to still live a long time, if you're healthy, there's no reason not to reduce that death benefit, save on the expenses. It's going to make up for it if you live 20 to 25 more years. But you don't want to give up hundreds of thousands in death benefit if you're sick, if for some reason you think you're not going to live that long. If you have a decade more to live, we're not going to worry about saving a few $1,000s in expenses if we're giving up hundreds of thousands in death benefit.
And I think that's an important thing is that we are talking about life insurance here. And while most of the time we're focusing on it as a financial tool, but one of those things is the death benefit is a financial tool. And that is something that you got to keep in mind. So in the end, if you're getting into those later years and there is a potential chance or you foresee a higher chance of passing away over the next few years, keeping a little bit of more death benefit in the end, especially if you're talking about like, okay, you're retiring at 65 and maybe you have some kind of issues that you foresee being a problem. I mean, realistically, it's not that much more expensive and you can hold on to that death benefit for a little bit longer, still possibly have more opportunity to fund it a little bit more, whatever it might be. But there's various things you can do, and I think that's important, as James mentioned, to have that conversation.
So to wrap it up, in an ideal scenario, you're going to have a policy that you purchase that has low expenses up front, and then we're going to manage it in the future to have low expenses as you get older. I did a video a long time ago on my YouTube channel. It's part 4 in my main IUL series, where I do 4 different designs and I break out the costs and the cash growth of all 4. And one of them is a high early expense, meaning you're going to pay the maximum commissions. In all of these, we're using an increasing death benefit. So some consistency here, but high early expenses via the commissions and high expenses later on, meaning you don't manage the policy to reduce the expenses down the road. And then I contrast and compare those with 3 other designs: a high early expense, but you do manage the policy down the road. So we call that the high early, low expense late. And then a low early expense, you got the right policy design for minimum commission design, minimum expenses, but then you don't manage it in the future. So that's a high expense down the road. And then the ideal scenario, low cost early on, low cost late. And wouldn't you know it, there's a massive difference between the low design and the high design. But in between there, we have the high early expense, but we manage the policy down the road. And then we have the low early expense, but we don't manage the policy. Carlo, which one of those do you think ends up being more efficient at the end of the day?
I would say the low early expense is going to be more efficient because you have that longer time to have more cash growth. That's my assumption.
If we're looking out around age 100, between 90 and 100, you're actually wrong. It actually doesn't hurt you as much to pay that higher commission early on with that specific product that I illustrated. Because when we manage the expenses at the end, there are tens of thousands of savings every year, even multiple tens of thousands of savings when you get into older age. Early on, when we do that early commission design, unless we're dealing with massive amount of money and a gigantic death benefit, we're talking, 40 or 50,000 in savings in those early years. But we could be saving hundreds of thousands of dollars in those later years just by dropping the cost of that insurance and making it a more efficient design at the end of the day. So yeah, those savings early on don't actually surpass the savings that we can get when we manage it in the future. But if you're listening to this podcast, you know you don't have to do it that way. You have the option to have the low early cost and manage the policy in the future and get the best of both worlds.
And I think It does make complete sense. My initial instinct was what it was, but I think that when considering things, this is why there's a lot of folks in this space who don't do the same types of designs that we do. But the reality is, once you hit that 20-year time horizon, it doesn't matter that much. And if you've had a policy, even if it's poorly designed, it can still do pretty well because you overcome those high early expenses, which are mostly going to be surrender charges. And then in the end, the policy is still probably do fine. However, still, and you compare it probably to that last scenario that James mentioned, of the low early and managing expenses in the late in life, I think that's going to come out ahead every single time if you do it right that way.
Yeah, there's one thing that I have to caveat is the poor early design. The only way it gets overcome is by that max funding. And a lot of people end up with or end up in the situation where they're paying for too much death benefit, they're underfunding the policy. And so instead of a 10% expense ratio at the beginning, it's more like 50 or 60% in the early years. And when you put in 10 or 20 or $30,000 into a policy and you see 30% or 40% turning into actual cash that can grow to try and overcome the expenses the next year, it's hard not to get dejected and not want to continue funding that policy. Even though when you first bought it, the agent had you looking 20 years out and like, yeah, it looks really good 20 years out. But convincing yourself to get excited about putting money into a high expense policy is the hard part after that initial purchase, because you're going to forget. You're going to forget the conversation you had with your agent. You're going to forget that excitement that you felt with this new financial tool that offers all of this upside. And you're just going to look at the numbers and they're not going to be very good. So get a good design, first of all, but make sure you max fund it. If you already own a policy, look to see if you're max funding it. If you're not max funding it, you're not giving it the best opportunity to succeed and overcome whatever expenses are in that type of design.
Yeah, and I think that's key. You got to really. That's why get in touch with one of us. As I'd mentioned, it isn't going to be bad. Like you can have something that's okay if you get one of those poor designs, but it's, as James mentioned, it is better to just have that peace of mind knowing that when I make a premium payment and I max fund, I'm seeing 90% of that become cash value or somewhere thereabouts, and you can have that too. And that feels good to know that you have access to those funds if you need them.
And we don't really say this very often on this channel, but you should really talk to us and you can avoid all the hassles. Because when we do design policies, whether IUL or whole life, the default design that we do is whatever's best for the client that minimizes the expenses, it minimizes the agent commission, because I have yet to see a design that when we lower the agent commission, that the client doesn't do better. In every instance that I've seen, if we reduce the commission, the client is going to have more cash value. And when the client has more cash value, the likelihood that that policy will succeed, the likelihood that they're going to be excited to fund it and max fund it increases. And that's what this is all about. The key to success in these things is sticking it out. You get past the initial early years where the expenses are a little higher. With a proper design, you still have massive cash liquidity. So we're not tying up those funds, but you still have a higher expense ratio. And we've got to overcome that. And even in a design, if it's well designed at the beginning and you get no growth for those first 7 years, we're still going to have an expense ratio that's down near 1%. Even if you get no growth during those first 7 years, as long as you've max funded it. So if we end up in a situation where for some reason the stock market loses money for those first 7 years and then it takes off for the rest of your life, you're still going to end up being pretty happy with that policy, even though those first 7 years are going to really be questioning what it did.
And I think one thing to consider, if you're in that situation, your money elsewhere is probably looking worse off. So that is something to keep in mind. And I think that is why we find comfort in these products.
All right, that's it for this week. Next week, we're going to be talking about the power of zero. It has to do with IULs and the reason these things can be so powerful and one of the reasons why they're so attractive as a place to supplement or complement the other investing that we're doing. So be sure to tune in for that. I'm James Barber, your Oregon Cash Flow Pro, and I'm licensed for life insurance and annuities across the country.
And I'm Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. And we'll work with life insurance clients across the country as well.
Take care. We'll see you then.
Thanks for tuning in.